Hey there everyone, welcome back to the Indus Trader YouTube channel and welcome you all to the fifth video of our free option course. And in this video we're gonna to discuss in detail about the option buyer. So before starting, let me show you something and let's recall some points which we discussed in the previous video. Yes guys, if you see, this is our playlist and this is named after free option course, and you can just go to our channel and you can search this. And in the first 4 videos we have covered different type of concepts like why future market when we already have cash market, and we have also explained different uses of future market and what is the difference between future and option market when we already have future market, why option market is introduced, and everything I have covered in this videos. And coming to this particular video, if you go back little, let's recap little main points which are needed in order to move on to this video. And before starting that, if you have directly jumped to this video, I would request you to go and watch these videos as well, because here every video is interlinked. And coming to, if you recall the main points, like future market, both the buyer and seller are obligated. And coming to option market, option buyer is not obligated but option seller is obligated. So hope till this point you are clear. And if yes, let's continue our video. If not, I would request you to go back and watch all these 4 videos and then after continue this video so that you will understand much better. So without wasting any time, let's get started. Yes guys, hope you know how to check the margin or like lot size, because all these things we have already covered in our previous videos, but yes, we're gonna to also see that in this video as well. Now coming to this video, if we talk, we are talking in the perspective of only option buyer, and option seller we have completely going to make a different video. The reason is we want to cover all the possible points in this video, and if we combine both option seller and buyer into one video, the first thing, it makes confused. The second thing, the length of the video also increases. So we want to make it completely different so that even you guys can understand it much better. So now for this video we have taken McDonald's, that is United Spirit Limited, as example for this entire video. So now let me open, if you see here we have a tab to just take the another layout. So even you have most of the platforms you have this, but personally I am using Fires, you can see here. And for this simple, you need to enter McDonald's. Okay, once you enter this here, if you observe, we have all types, and if you just click on futures here, you can directly see this. And in the previous video itself I have entered how to understand this 24 Jan 25 FUT, everything I have explained. And if you are watching continuously, I want you guys to comment below what this exactly mean. Okay, now I have selected future chat as well. Now let me also open one more layout for the call option. So now the thing is, we have 3 different members, Ramesh, Suresh and Sri. Let's assume we have three friends or like 3 colleagues. 3 members have the same bias, that is long bias. They are expecting McDonald's from here on, they have the long bias, and they are expecting a bullish move from here on. So now let's see what is the lot size. How can we check? Obviously you can go for NSE website and you can check, but still you can come here and just if you click on buy or sell option, then you can directly check here. So what is the fund required? If you see, almost near to 1,52,000. Okay, and let's make a round figure for easy understanding. But if you see, somewhere near to 1,51,820 or 17 rupees, we can round figure it as 52,000, because even we are increasing the price here as well, right? For easy calculation purpose, that's it. And for, if you see what is the lot size, you have seen here it's 700 quantity. So now let's see the spot chart. For spot chart, if we are buying 700 shares of McDonald's, then we almost required 7.45 lakhs. Okay, now we required 7.45 lakhs, and in the futures we required almost near to 1.52 lakh. Now as the bias of 3 members is bullish, we are taking the call option. So now let's go and take the call option here, and need not to worry about which option we should select. Okay, so it's need not to be worry. In upcoming videos we're going to cover in detail about every concept. If I am missing anything here, don't worry, in the entire series we're going to cover everything. So now let's again, for the calculation purpose, we are taking this as 30 rupees. So how to calculate the margin? See, the margin is not reflecting here, I do agree. For calculating, it's very easy. Just you need to multiply the quantity with the premium. We call this as premium, right? For the premium you need to just calculate, so you will get the margin required. For futures it will be different calculations. As you know, we get some leverage, so no need to worry. Let's directly jump. Yes guys, directly jump into the content. And yes, before starting, I am again repeating, the option buyers are not obligated, option sellers are obligated. This one point makes the major difference, and this point is helpful not only for this video, for the upcoming videos as well. And all the logics we have explained in the previous videos, but let's see pros and cons in detail in this video. So now in our example in the chat as well, I said Ramesh, Suresh and Sri. Here Ramesh is an investor and Suresh future trader and Sri is option trader. So what option Sri is trading here? Call option, because all these three guys bias, or all these three guys are bullish on McDowell's stock. So now let's jump. Assuming the followings, if you see 3 members have the same bias as we already discussed, and the main point here is holding positions till expiry. See, it is need not necessary, like if we taken any position in F&O, and we need not to hold that till the expiry. If we are getting profit, or if we are getting the minimum loss, whatever we have expected, we would close our positions. Okay, but for this video we are assuming all the examples till they are holding till the expiry, and need not to worry what we do if we get profits, or if our stop loss is hitting, or like if we want to exit before the expiry itself. Everything is going to be covered in this entire series, but we have planned everything in a particular plan. So for this video, just assume these three guys, Ramesh, Suresh and Sri, are holding their positions till the expiry. So let's move. Now the first thing, if you see, I have just made a round numbers here. The spot price is 1100 and future price is 1105, 1105, and the spot price, let's assume, as they have expected the price will be on bullish side, so let's assume the price is increased by 100 points. So what happens? So let's see. Ramesh investor got at the time of expiry, on the expiry the price is now 1200. That means from the investment of 1100, he almost in the profit of 100 points. So 100 into 700, his profit is 70,000 as of now. Now let's see the future trader, and if you see 1200 is the present price and minus 1105. So why we are getting 95 points and why spot trader is getting 100 points? We already discussed this point in the previous videos. So hope I need not to say every time this. One who are watching continuously, they know it much better. So now the future trader, if you see 95 points into 700 is the lot size. So the profit Suresh got is 66,500. Now if we talk about the investments, Ramesh invested 7,70,000 to buy this 700 shares in the cash. And if you see the ROI, it's almost 9.1%. That means for every 100 rupees he invested, he is getting 9 rupees and 10 pies. And if we see the same thing with Suresh invested almost 1,52,000 and he got a profit of 66,500. And if you see the ROI, he almost got 43.75, which means for every 100 rupees Suresh invested, he almost got 73 rupees 0.75 pies. And what about Sri? So let's check out. Now if you see, Siri bought a call option which worth of 30 rupees at 1100 when the McDowell stock is at 1100, but now present it is trading at 1200. So can we say directly she is getting 100 points profit, so her profit should be somewhere near to 70,000, right? No. If this is the case, everyone will do this trading only, right? Because if you remember the premium, whatever the advance, if we talk from previous examples, the advance or the premium which is paid by the option buyer, irrespective of the situation, whether he is executing the trade or whether he is not executing the trade, that premium will not get back. So hope you understand. So what is the right way to calculate here is, you have to calculate, we are getting 100 points difference, but we have paid 30 rupees premium, non-refundable premium, so we need to also deduct that, and after deducting we will get 70 points profit into 700, that is almost 49,000 profit. And what is the invested amount by Sri option trader? It's 21,000. And if you see the ROI, for every 100 rupees Sri invested, he or she got 233%. So just imagine the ROI. So might be you are thinking option trading is best, less investment and high returns, right? Don't be early, watch the entire video, and by the completion of this video you guys will tell me, or you guys can decide yourself which sort of trading suits you. So let's see the another situation. So the first situation we have seen, scenario 1. If you see in the scenario 1, stock rise by 100 points. Let's say what happens if the stock drop by 100 points. So the spot price on the trading day is 1100 and on the expiry day it's almost near to 1000 now. So let's see how the P&L affects on this, guys. And one more important point here is, all the trade charges and brokerages are excluded here. Even you need to calculate that, but that is out of syllabus as of now. So we are only calculating the exact numbers, and you need to also add the taxes, but it is not necessary here because the concept, understanding the concept is important. So now we are considering scenario 2, stock drop by 100 points. So now let's see how it affects Ramesh the investor. And if you see, almost the price is now 1000 rupees and it's almost dropped 100, so obviously his loss is 70,000 rupees. So now how it affected Suresh? So if you see Suresh, it's 105 points into 700, and if you don't know how, just watch the previous video. Okay, now 73,500 is his loss. So if you see the invested amount of Ramesh, 7,70,000, and if you see the ROI, he almost lost 9.1%, which means for every 100 rupees he lost 9 rupees and 10 pies. And let's see the Suresh case. And in Suresh case, he is invested 1,52,000 and he almost lost minus 48%, which is like almost half of his invested amount. This is the risk we usually have in the futures, and this is the risk we usually have in the leverage products. Okay, anyhow, let's continue. And if you continue the Siri option trader, loss is 100 into 700, because obviously 1100 to 100, almost 100 points is we have loss of 100 points into 700, it's the lot size, right? Almost near to 49,000 is the loss. Is it true? No. And if you are thinking the same, then you are on the right track. So if we calculate 100 plus 30, okay, 100 is the point now he is getting the loss, and if you add 30 non-refundable premium, then if you multiply that with the lot size, the almost the loss of Sri is 91,000. But here, if you remember, option buyer is not obligated. Why he will pay 91,000? If he is getting 91,000 loss, he will not execute the trade. So if he not execute the trade, what is his loss? His loss is only his premium. So what is the exact loss here? That is 21,000. Okay, only 21,000 is the loss. Okay, loss is equals to premium. You don't take this, just to make you learn this. I have entered wrong here, and the max loss of a option buyer is his premium. So ROI 100%, minus 100%. For every 100 rupees or for every 1 rupee he invested, he lost everything. Okay, so now let's see the different situation now. Scenario number 3. In the first scenario, the stock raised by 100 points, and in the second scenario, stock dropped by 100 points. Now let's say normal rise. It's like stock rise by only 30 points. Okay, now let's see how it is affected on the Ramesh. It's almost 30 points in profit, and his profit, if we calculate, 21,000, and the amount he is invested, and ROI is 2.7%. That means for every 100 rupees he invested, he almost got return of 2.7 rupees. And if we come to the Suresh, the future trader, if you see, almost 25 points, but his invested amount is 1,52,000. The ROI is 11.5. Now coming to option trader Sri. Option profit is 1130. That means already he is in profit of 30 points. But again, you have to remember, the 30 points which we paid the premium is not refundable. That means option buyer will get the profit only once his premium cross. Okay, from here if you see, he did not cross the premium, he is under the premium itself. So now if you see, the loss or profit he get is nil. Okay, so here you don't consider this. Let me edit. Sorry for that, guys, but here the loss is nil, because yes, of course there are charges, I already explained you, but in this situation he is not getting any return. Okay, so now let's see one more situation. We have considered 3 scenarios till now. In the first scenario, we have seen the price is moved in our direction for 100 points, and we have seen the second scenario where the price moved against 100 points. In the third scenario, we have seen the price is moved only 30 points, and in this is fourth scenario where we are seeing the price is unchanged. So let's say how this particular price is unchanged effect on all these 3 type of investors or traders. So if you see Ramesh investor, he do not have any effect, because he is invested. He will say, I will see on the next upcoming days, no need to worry. So his ROI is 0. In this particular situation, he is not affected. And coming to futures trader, he almost lost 5 points, and if you calculate that, it's minus 3,500. And for every 100 rupees he invested, he almost lost 2.3 rupees, and this is like not a big loss. And once you are into stock market, this sort of losses are acceptable and very common. And coming to option trader, so the price is unchanged, but still, even you need to understand that the premium is not refundable. For option buyer in this particular situation, if the price is unchanged, still he is losing everything, the premium which he paid. And yes, for the option buyer, the profit will start once the market move in the possible direction. And yes, option traders get profit only after the move should be in the predicted direction. Let's say if he is predicting long or short, the move should be on that particular direction, and the move should be above the premium paid. Okay, after the premium everything is his profit, or else it's loss. Okay, so now all of you just go through this. Now first thing, we have gone through call option result. Now only we are discussing about Sri. So Sri thought McDonald's will move to the bullish side from here on. Yes, if it is moving on bullish side, he is or she is getting profit. Or else if the market is moving against, then he is getting loss. And if market is staying there only, still we are getting the loss. And you might guys say, now what's wrong? When we are getting about 200%, and when we are losing only 100%. Yes, you are right. But if you see the particular thing, the favorable situations, only one situation is favoring out of 3. So by this, what we can say, the one thing which you need to see is the win rate is low for the option buying. So after listening all these things, you might be showing this emotions on me, right? What do you mean option trading is not worth? Most of you might be asking me this, like you said, come and join my channel and watch free option course, we will teach you, and now you are saying options are not good, right? Don't be worried, I said just watch the entire video, then after you take the decision. Okay, so now let's take some special situation. Now let's assume Ramesh, Suresh and Sri have 15 lakhs with them, and but according to their comfort zones, Ramesh invested in cash market and future, Suresh thought to take the futures contract, and Sri thought to go with the option contract. Now yes, both 3 members have the same fund, and but they have gone through different style of trading or investing. Okay, now let's move and check what happens if the price is moving against them and if the price is moving favor to them. So now let's see. In the first case, the price is moved almost 1300, that means 200 points it moved in their direction, the direction which they expected. And if you see the profit and loss, almost invested 7,70,000 and he got ROI of 18.18%. and if you see with the future traders, he almost got 89.8% return. And if you talk about Sri, option trader, he or she almost got 566%. So hope you understood. You have seen the scenario of 1 as well. If the price is moving in the direction which they have expected, here the both here the 3 members Ramesh, Suresh and Sri have the same bias. The McDonald's will move, or they are bullish on the McDonald's. So in the scenario 1, the price is moved in the direction, and in the scenario 5 the price is moved in direction. And in the both the scenarios, 3 members are profitable. And yes, the difference is there. According to the leverage products have the higher risk. Okay, and if you even see, the risk is higher in the futures. And coming to options, you already know, and we are doing this. So now let's see one more situation. Yes guys, now the price decreased or dropped by 200 points. The price moved against this guys of 200 points. Now if you see the ROI, Ramesh almost lost 18% and Suresh lost almost 94%. And if you see, when the price dropped 100 points in the scenario 2, almost Suresh lost 48% or near to 48%. But if you see in the situation of 100 points drop or in the situations of 200 points drop, Siri got 100% lot. In the both the case, whatever the amount he have invested, everything is he lost everything. Okay, so now let's see the situation. This is the worst situation. Let's say after these guys have invested, we got a very negative news on McDonald's, and the stock price is dropped by 300 points from the this guy's invested price. So just go through the losses again. This time we see quickly everything. Okay, and if you see ROI, for every 100 rupees he lost 27.2%, the investor one who have invested in cash, and his loss is almost near to 2,10,000. Now coming to Suresh, he lost almost 2,13,500 rupees, that is 140% of the amount he invested. Okay, but coming to the Siri case, again here she or he lost 100% ROI, and again the negativity continues. Let's see the one more scenario. Let's say again one more 100 points, that is almost near to 400 points. Let's say 400 points it is corrected. Okay, so now just watch this profit and losses. The investor almost lost 2,80,000, that is 36.36%. For every 100 rupees he invested, he lost 36 rupees or 37 rupees. And for future trader, 2,83,500 rupees he lost. For every 100 rupees he lost 186 rupees. But coming to Sri, he lost every penny which he have given, because here in this case if you consider losses, that will be huge. But as I said, these guys are obligated. Just leave Ramesh investor, but if we compare this both guys, Suresh is obligated. He is obligated and he should take this loss. But coming to Sri, he will not or she will not. Okay, so they will not execute the trade. That's the reason they will book the loss itself. So now by this, what can we conclude? The one thing, if you continuously observe this, in this case where the Ramesh, Suresh and Sri have 15 lakhs with them, but thereafter they have choose a different approach to invest that. So here if you see this in the spot and future case, loss keeps on increasing. In our case we have taken few scenarios like 100 points drop, 200 points drop, 300 points drop, 400 points drop. Let's say even it is dropping 500, 600, 700, then their losses keeps on increasing, the spot and future. But if you observe call option max losses, the premium which he paid. In our case, what is the premium paid by Sri? 30 rupees. So what is the amount invested? 21,000. What is the max loss? 21,000. Whether the 1100 invested price even it becomes 100, then if you see the spot and futures have the unlimited loss. Okay, but if you see this particular call option or option buyer, is the premium is only his loss. So here if you again conclude that it's limited risk and unlimited profits. So now again we go back to the one thing which we discussed earlier. So yes, obviously option buyers have very low win rate, because for every 3 possibilities we have only one favorable situations we have, only one probability or favorable situation we have out of 3. But if you just remember, if the price is going in our direction, then we get profits, but the profit we will get only after the premium we paid. Let's assume in our examples only, let's discuss. In McDonald's, Sri invested 21,000, that is he paid the non-refundable premium, which is 30 rupees into 700 is the lot size, that is 21,000. This 21,000 irrespective of the situations he is not getting back. So after 21,000 or above 21,000, or above 30 points. In this way we can say he is or she is invested at 1100. So after 1130 he will start getting the profits, or in both either case he will exit in loss, and that too with 100%. Like every 100 rupee or every penny he invested, in both these situations he will get loss. Okay, so now before going to put option, if at any part of this video if you liked my efforts, then don't forget to like, share and subscribe, because that keeps motivating me to make this sort of videos. Are you at least getting some idea which sort of trading suits you? And by the end of this video or next video, you will come to an idea like which trading suits you. It doesn't mean like you should be a option trader because your friend is a option trader. You need to be a future trader because your relative is a future trader. No, you have to decide which sort of trading style suits you. And in this case we have gone through different scenarios and hope you understood everything. If not, let me know in the comment section. We will also make Q&A session for this particular video, or for the entire series we will make a Q&As as much as possible as you ask the questions. Yes guys, now let's discuss put option. So let's say Suresh and Sri, we are taking only two examples. The reason is for we don't have SLB function now in our market, so we cannot short in the cash market. So that's the reason I am comparing only two members, that is future trader and option trader. So similar case need not to keep that the same situations and the same scenarios which we have discussed in the call option works for the put option. And even I'm explaining one example, thereafter even I would conclude it. Still, if you want, let me know in the comment section, so we make a dedicated video for that as well. But as I am assuming it is no need, so that's the reason we are taking up only one scenario, that is the price drop by 400 points. Okay, so now this put option, Siri is put option buyer and Suresh is future trader. Suresh sold futures at 1100 rupees and almost he booked 2,83,500 rupees, and on the return on investment it 186.5%. that is for every 100 rupees he got 186 rupees. Coming to Sri, he is invested only 21,000 and ROE is 1233%. Amazing, right? It's like almost for every 100 rupees he is getting 1233 rupees. So yes, these are just numbers and these are very rare situations, but still just to make you understand the concept we have taken best and the worst case and I explained you. So now the similar thing, if you come to put option, if price is dropping from the spot price, if the price where these guys have invested from there, if the price is dropping, that means correcting or getting bearish move, then both future trader and option trader will have the profits. But let's say the price is raising or moving against this particular view, short side view, then obviously Suresh have unlimited loss. But Sri, what is the loss of Sri? I want you guys to comment below so that at least I would know how many of you are following. And if not, then don't worry. If you don't know the answer, just try to answer in the comment section. If not, I will just in the next video, in the starting itself, I will start with the answer. So now let's conclude this. Okay, future loss keeps on increasing on every rise. That's what I said. If it is moving upside, or if it is moving bullish, or if it is moving towards long, then obviously futures have unlimited loss. As that keeps on increasing, the futures will get loss. Now what is the maximum loss? This is the question I asked, and answer is also here, but still you can answer that. And by the way, here even you can see something, what is the premium we calculated, and yes, Answer is also on your screen, and I hope you will comment that. And yes, option buyers have limited risk, unlimited profits, but the biggest concern is the favorable situations for a option buyer is 1 out of 3. And hope you understood, and see you in the next video. Until then, this is Krishna signing off. Jai Hind.